China jitters on Dalal Street. Yet again, Indian equities fell like 9 pins as the meltdown in China weighed heavy on sentiment. The Sensex tanked 500 points on panic selling to end below 28,000. The Nifty also fell through the crucial 8,400 mark, with metal and auto stocks taking the maximum hit. Back in China, markets tanked once again, with the Shanghai Composite losing almost 8% in trade. The carnage has been so severe that investors lost over $3.5 trillion since the beginning of June. The tremors were felt in the commodity market as well, with metals taking a heavy beating.
Apart from China jitters, a possible Greek exit from the Eurozone is also not helping the cause of investors. And indications are that Grexit may in fact be a reality sooner than later. Addressing top European leaders in Brussels, Greek Prime Minister Alexis Tsipras gave no signs of a let-up, saying that Greece is not a lab rat for an experiment on austerity. A euro breakup, if and when it happens, could lead to high volatility across financial markets all across the world, and aftershocks will be felt in India as well. The mayhem on Dalal Street against the backdrop of China and Greece shockers is our top story right here on Business Tonight.
No one tracks markets the way we do, and so tonight on Business Tonight, we've got a complete analysis of the Chinese meltdown and its impact on India and other emerging markets. What led to the massive sell-off, and should India get more wary of China than Greece right now? That's the big question we're asking on the show this evening.
Absolutely, and we're joined by Tanvir Gill, Gautam Srinivasan from Singapore, Ayesha Faridi and Nikunj Dalmia from our markets desk right here in India, Mythili Bhusnurmath with an expert take on all that's happening, and Manisha Gupta with a quick roundup of the commodity carnage. Tanvir, to you first. What is really causing all of that pain in equities in mainland China? There are jitters coming from there, but what is the root cause of all that pain?
Well, China has been the biggest disappointment for investors in 2015, and here's why. Another 8% gone on the Shanghai index, another 33% gone on the Shenzhen index, and both these markets would have completely wiped out officially their gains into the year so far. $4 trillion of market cap wiped out from the equity markets. And remember, what seemed like a problem which essentially was hitting the equity markets has spilled over into the fixed income markets as well. Good rated corporate debt paper in China is being sold into. And of course, even the forex markets, the yuan, which is freely traded in the offshore market, has hit a 4-month low. Enough risk for the regulator to sit up and take notice of and step up to stem the fall. So what they've done is asked the CSF, which is a margin funding unit, to buy small cap stocks, to buy blue chip companies. The PBOC has been asked to give enough funding to the CSF to continue buying stocks at lower levels. In fact, the PBOC has infused enough liquidity in the system by cutting the reserve ratio by another 50 basis points. Insurers have been asked to step up on buying blue chip companies, and you've had state-owned companies being asked not to sell their holdings in the public listed arms. So all in all, the regulator is ensuring that this does not spill over. The risk that we are seeing in the equity markets as well as the fixed income markets in China should not spill over into a potential systemic risk which can affect the rest of the region.
All right, let's take it across to Gautam, who tracks the Chinese markets very closely. Clearly, Gautam, the turmoil continues. Nowhere to hide for Chinese investors. How will you describe today's sell-off? Take us through what's been a dramatic trading day for China.
It was a day of infamy as a Chinese tidal wave swept across many Asian markets. Nikkei saw its biggest drop in more than a year, with construction equipment makers exposed to China, such as Komatsu and Hitachi Construction Machinery, skidding in trade. Even Singapore's usually calm stock markets got caught in the whirlpool. Shares in Hong Kong suffered their biggest one-day drop since the financial crisis of 2008. Let's focus on the protagonist for today's tragedy. That's China, not Greece. The CSI 300 fell close to 7%, while the Shanghai Composite lost nearly 6%. The meltdown came even as the government tried to unveil supportive measures throughout the day to insulate themselves. More than 500 China-listed firms announced trading halts before the market opened. That brought the total number to around 1,300, which is almost half of China's roughly 2,800 listed firms. Now, some analysts saw all those share suspensions as a cause for the sell-off. Financials such as Ping An and energy counters like Sinopec hit the daily lower limit of 10%. Bank of China, China CITIC Bank and China Life were among the few who survived the onslaught. Bank of America Merrill Lynch says the deleveraging in China could be far from over.
All right, back home here on Dalal Street, the markets did take a heavy blow on its chin today. All sectors ended sharply lower. Ayesha is joining us with details from Dalal Street. How much did the China meltdown and the commodity rout really rub off on India, Ayesha? Pain points there?
Yes, the China jitters and the commodity rout sure had a rub-off effect on our markets as well. To be fair, though, we were already riding as high as 85.50 thereabouts in yesterday's trading session as well, when we saw a touch-and-go moment with that mark. And from yesterday onwards, we did have the signs of a market which wants to profit take a bit yesterday itself. And today that only got accelerated thanks to the way the Chinese and the commodity markets were panning out. Net result, we're now below the 200 DMA on the Nifty, cracked below the 8400 mark, started off with a gap down of 1% and traded sub that throughout today's trading session, finally closing just about around the 83.50 mark, which again, by the way, we breached intraday as well. You had the India VIX, which has spiked up almost about 9%. All sectoral indices were in the red today, with metals being the biggest drag. And all components of the Nifty, all 15 names, they were deep down in the red as well. It was no better when it came to the broader markets too. The advanced decline ratio was well in favor of the declines today, with almost a 1.5% cut coming in for both the mid as well as the small cap indices. Metals, predictably, because of the commodity rout playing out, were the hardest hit, with names like Vedanta at the bottom end on the Nifty and dragging almost by about 8% or so. You also had the likes of SellOff, Jindal Steel, Hindalco. They all dragged pretty much a lot. Not just metals, but the weakness was also pilfering through sectoral indices like in auto, bank Nifty, media, IT, as well as FMCG. Amongst the banking names, the UBS report on Yes Bank definitely didn't augur well. That cracked pretty hard today. BOI, SBI, ICICI Bank, they all fell on their chin. Care and Tata Motors, HDFC and ITC were your other blue chip draggers today. The other losers were the likes of Federal Bank, JP Associates, Bajaj Finance, HDIL, which within the broader markets and the F&O universe felt a lot of pain, and just a handful of gainers, none of them Nifty names, but Narcom, Crompton Greaves as well as Exide just about managed to scale through in the green today. So a fair amount of pain is what we witnessed today, and perhaps this is going to go through come tomorrow as well. But let's see how China pans out tomorrow. We'll catch you in the market and find out just that.
All right, the big question then, what's going to be a bigger pain point for our markets going forward? China or Greece? Who better than Nikunj Dalmia to throw that question to? Nikunj, which is the bigger worry for India, or is it going to be something completely different, which is our earnings season?
Well, Greece is important, Greece is crucial, but China holds the key. Let me share some numbers with you. The size of Chinese economy is about $8 trillion. The size of the Greek economy is only $100 billion. Chinese stock markets, even after a 40% drop, are 4 times bigger than Indian stock markets. So clearly, China will have a much greater domino effect on all financial markets, on all asset classes, at least in the short term. The 2002 dot-com crash and the 2008 financial market crash have taught fund managers one simple logic, which is in the short term, all financial markets, all asset classes, they are correlated. Since fund managers have lost billions in Chinese stocks and local investors have lost millions in China A shares, that clearly is having a negative impact on commodities. Can the commodities sell-off have an impact on emerging market equities? Surely it could, because it's a matter of time. Exchange traded funds, ETFs, which run books worth trillions of dollars in emerging markets and in other markets, they could see outflows. So I honestly worry about China in the short term. Long term, well, India will benefit. The problem with Chinese stocks is that rather than wealth destruction, foreign investors have lost trust and faith. By design or by default, India is the only large economy where global money will move. BRICS is no longer a nomenclature where everybody is investing. Within BRIC, it's only I which is standing out. So in the short term, I am beware of the entire domino effect, but in the medium term, in the long term, India is where you should park your money.
All right, India is where you should really park the money, but Mythili, for you, I do understand you don't believe this is a contagion that's going to spread so far. You believe this is limited just yet. Why do you believe so?
Well, the main reason really why the contagion has been limited, in fact has not been to the extent that everybody anticipated, is perhaps because FII participation in the Chinese mainland equity market is very limited. It's just about 1%, as against 25% in the case of India. FII participation through Chinese stock market is essentially through Hong Kong. So till such time as the pain is limited to the mainland market, the direct contagion effect is going to be limited too. The problem really would be if this is a reflection of the pain in the Chinese economy in general. And that is where one will begin to worry, because if China really slows down and the order of the slowdown is as dramatic as it seems to be from the asset price bubble, then we could be in for more serious trouble.
Okay, let's try to understand the implication of all of this in the commodity space as well. Manisha, equities, commodities, currencies, the rout was all across, but how bad was it for commodities?
But it has been all C's which have been underperforming, and commodities really leading the pack with all of that. You have seen sharp declines coming in because of the Chinese selling, the concerns in Greece, and of course the hedge funds also now creating short positions in many of these commodities. The major hit has come in for the base metal space because Chinese demand has been on the lower side, and many of these physical base metal has been used as a collateral in Chinese equities. So a sell-off there has impacted this sector the most. If you look at the aluminum and zinc prices, they are trading in the bearish territory already. The iron ore prices are in a bearish market, and the steel prices are trading at a 20-year lows with 27% of decline for 2015 till time. Copper prices are trading at a 6-year lows. You have seen 15% of a cut in 2015, all to that one as well. When it comes to the energy market, remember that has been the top story all of these days, and it's just a couple of percentages away from entering into the bearish market. The Iran and the 6th major world power deal is expected quite likely, if not in coming this week itself, then in next 3 months, and that would mean more oil coming in from Iran. It has been record high production from OPEC, from Russia and from US as well, so that would continue to pull the prices on the lower side there. The gold and silver then have relatively performed better as compared to other commodities, but they also are now in the negative for 2015. Having said that, there is no commodity at this point in time which is positive for 2015, and the way the global concerns are building up, we haven't really seen the bottom on that yet.
All right, thanks for that, Manisha, Ayesha, Tanvir, Nikunj, and Mythili and Gautam as well, for putting it all in perspective.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.